What if I told you the key to financial success isn't how smart you are with numbers, but how well you understand your own emotions? Today, we're kicking off our financial book club with one of the most talked about money books out there, The Psychology of Money by Morgan Housel. And trust me, this one might change how you think about money forever.
It's another episode of Your Retirement Elevated. I'm Walter Storholt alongside Scott Dugan, of course, financial advisor that's going to walk us through another great episode here. And this one is right up your alley. Scott, I know this is one of your favorite things to talk about is psychology and money. And Morgan Housel, an author that you have, I think, enjoyed following over the years. And you're excited to kind of spotlight his book and dive into our book club on today's show.
Definitely. And I had the great pleasure and honor of actually being sharing a stage with him in Denver in 2024 at the premiere of the movie The Psychology of Retirement, which I was a contributing producer. So there's me sitting next to Morgan, very bright individual, and he just has a way of telling stories and making the really complex simple. And so it was a great honor to do that. So when we were talking about having a book club, I thought this would be the great one to kick it off.
You and the missus got to have a nice time out there, and we've talked a little bit about that movie as well over the last couple of last year when it first came out. We talked a little bit about it, so we'll put some more information in the description of today's show if you want to see the movie and get more information about that. It's definitely would be a nice compliment to what we're going to discuss today. So,
Definitely.
You guys were looking fresh on the red carpet, I have to say.
Yes. Had to break out the tuxedo for that one.
That's right, exactly. Well, for those who haven't read The Psychology of Money, let's give you a quick overview. Can you do that for us, Scott? Give us that Cliff Notes version, if you will, or read the back cover in your terms.
Definitely. Really, The Psychology of Money is a best-selling book that explores the human side of finance. So instead of focusing on formulas or strategies, Housel dives into the behaviors, biases, and beliefs that drive our financial decisions, often without us even realizing it. And so the book is broken into 19 short story-driven chapters, each one designed to challenge the way you think about money.
And what we're going to do on today's episode is give you 4 key takeaways from the book. In case you don't have time to go read the entire thing right now and dive further into it, we're going to let you be part of. I've been in a couple of book clubs over the years, Scott, and I've got to raise my hand and say I haven't read every book that I've been in a book club for. So I imagine that might be some of our listeners as well. So we're going to let them kind of be in that role, not having read the book, but we're going to let them be in the book club anyway, right?
Definitely.
Okay. Perfect. So the first concept is no one is crazy, and kind of was couched this way from Morgan Housel, saying, hey, your personal experiences with money make up maybe 0.000, I'm not going to read all the zeros, but a lot of zeros, 1% of what's happened in the world, but maybe 80% of how you think it works. I thought that was a really interesting quote from the book. What's your insight from that no one is crazy concept?
Well, I think there are some crazy people, but in the context of this, so no, in all seriousness, people's financial choices often make sense to them, even if they don't make sense to others. A client who lived through the Great Depression might hoard cash, while someone raised during a bull market might be overly aggressive. Now, neither is crazy. They're just reacting to the experience that shaped them.
Makes a lot of sense. So my question for you as an advisor, how do you see maybe generational or personal history kind of shaping your clients' reactions and decisions to the financial world?
Well, I can tell you when we talked about that Great Depression, when I started almost 25 years ago, I had a lot of clients that were airlines that I ran, but TWA, the airline, North Kansas City was a big hub for them. And so a lot of the people I dealt with, grew up during the Great Depression. They worked, a career for a long period of time, got a pension, had Social Security, and worked hard. Didn't have to save a lot, weren't aggressive, but lived below their means. And they weren't big consumers of things. And their big thing was they wanted to leave as much money as possible, to their kids or grandkids. They wanted them to make sure they went to college. And so that was a pretty solid across the board what people wanted. And if you fast forward to today, almost 20 plus years later, a majority of my clients, don't have pensions, have been really good savers, have 7 figures and over saved for retirement. But they see that money as what's going to supply them a paycheck to do the things that they want to do. And definitely, do they want their kids to be better off? Absolutely. But what a lot of them view it as, hey, we've done our part. We raised them. We gave them tools. We sent them to school. We got them started. The money that we've saved, that's for us to do all the things we want to do. Now, sure, we're going to share it along the way, do some great experiences. But if there's no pot of gold at the end of the rainbow, there's not a lot of our clients that are overly concerned about that. Now, granted, there's going to be, because the reason they have, established a nice nest egg is because they are frugal. But again, it's just the way they're coming at the kids of those people that I started with, 25 years ago. And I would say the people that, really entered the workforce in the last 10 to 15 years, think about all the market gyrations that they've been through. Interest rate hikes over the past couple of years. So you're going to see the people that are just starting out now, where mortgage rates are higher. They're not getting houses as soon, not getting married as quickly, not having kids as young as they used to. That's really going to shape, the next several decades for sure.
Makes a lot of sense. And I think about my own personal experiences of, graduating from college in 2009. So right after everything in the economy cratered, and how that's shaped my views of work, money, finance, saving for retirement, so many things with my early working year experience being during that time frame. You shift that by a couple of years and I might have a totally different attitude about maybe certain things. So I know everyone could probably do that same math as they think about their most formative financial experiences. All right, so no one's crazy except for maybe a couple of people out there. But
yes.
Concept number 2 is the trap of never enough. And Morgan Housel says in the book, the hardest financial skill is getting the goalpost to stop moving. Boy, you could apply that to a lot of things in life.
Oh, absolutely. And looking at this, thinking about, people that I've worked with over the years, even some of the wealthiest people in the world self-destruct because they can't stop chasing more. They risk their freedom, families, reputations, health, not because they need more, but because they couldn't define enough. They couldn't draw a line in the sand. And this happens with a lot of the executives that we've worked with over the years, where they've done the right thing. They've saved the money and they've put it away, but they just can't pull the trigger because at their highest peak earning years, and they're deriving so much self-worth by their position, by their income, status, that more and more and more, they just keep going. And I can think of one client that it was the retirement was always 3 or 4 years from now, 3 or 4 years from now, 3 or 4 years from now.
Just kept pushing it out.
Just keep pushing it out. And finally it was a health scare that luckily turned out to be, nothing serious, got him to the point like, hey, I know my wife has been ready for me to be retired. This is a big enough scare. Who knows if this is going to happen again? I may not be lucky next time. We have enough. We are good. I'm ready to chart the next course and figure out, what drives me through this next phase of life, but it doesn't need to be from status of their career.
It's too bad that it takes something so impactful, though, so, earth-shattering, like a health scare like that, to then force the action and sort of what the original design of their plan and their attitude was. So that moving the goalposts is really tough. It's hard to feel content when you're keeping up with the Joneses, or even if it's not that's ailing you. It's just that it's like the Newton, one of the Newton laws, right? Object in motion stays in motion. It's hard to undo that.
Yeah, absolutely. Absolutely. So again, they struggle, but once they do find contentment, then it's usually a good transition into the next phase.
Is your retirement strategy working as hard as you are? Get the answers you deserve with Elevated Retirement Group's information-packed toolkit. Inside, you'll get Scott's book, Exceptional Retirement, along with essential insights covering the 5 key areas of retirement planning, strategies to keep more of your hard-earned money, and how to choose your winning retirement team. Take control of your retirement today. Click the link in today's show description to claim your toolkit at no cost to you.
Okay, our third key concept from the book here is reasonable is better than rational. Aim to be reasonable, Housel says, not rational, which is a little bit like whoa, we're talking about finances. Like rational is supposed to be probably a virtue here.
Oh, definitely. But I think his point is, not every financial decision has to be the most optimized one on paper. Sometimes the best plan is the one that lets you sleep at night. That might mean paying off a low interest mortgage or, investing in a family startup, not a lot, maybe a little, because it brings peace of mind, not peak returns. And one of the strategies that we use to help people get like an emotional peace over mathematical perfection is when we ask, what do you envision? What do you want to experience in retirement? What do you not want to experience in retirement? What does that look like? And once we find out what type of resources are going to be needed to drive that retirement from a cash flow perspective, then we do the calculation to figure out what's the lowest rate of return that we need to make this all mathematically work. Keep up with taxes, inflation, lifestyle, all those things. So we go into this saying, hey, you need to make X to make all this work. And so crazy thing, a lot of our clients, it's 3 or 4% rate of return over their lifetime to make all this work mathematically. Well, if they're coming in invested trying to make 7, 8, 9, 10%, well, do they need to do that? Well, they don't need to, they can, but we reframe that conversation to say, here's your baseline to make this work. You can make a conscious decision to be more aggressive, but let's maybe not be aggressive with everything. And so that's one of the strategies we use to kind of reframe this and get people to be reasonable, and not reasonable, but over rationality, I guess you could say. Reasonableness over rationality.
Yeah, it makes a lot of sense. Sometimes if it's something that makes you, it's just like anybody's going to learn through life. Sometimes you pay a little more for convenience or, peace of mind over something else in life. Just whatever those little extra things that you value more, they can outweigh what is that most rational or financially savvy decision because it's bringing you some other benefit, some other element. So that one makes a lot of sense, but sometimes we lose sight of that. So I think that's good to highlight. Concept number 4, our last one, is to build in room for error. Housel said a margin of safety is the only effective way to navigate a world that is governed by odds, not certainties. Your take on that one?
Definitely. And, room for error isn't just smart. It is essential because life throws you curveballs and a good plan doesn't assume everything will go perfectly. It builds in buffers. That's why we have emergency funds, conservative withdrawal rates, flexible spending. That's to help keep clients on track even when life gets messy. And we talk about, if in today's retirement, it could be 10, 20, 30 years of permanent unemployment once you retire. So once you have that, 2 or 3 decades, you're bound to see things happen. Interest rates go up or down, inflation up or down, market cycles up and down. So again, you're either going to be on track, off track, or ahead of schedule. And so it's important that you put up the correct guardrails to keep you in a range that you're going to be comfortable with. And that's what we do at our firm, is to establish those guardrails to make sure that, hey, we're going to, as long as we operate between these, we've agreed you're going to be okay. And so we got to look at, sometimes, again, you're on track, off track, ahead of schedule, but it's all about course correction. If you think about, my wife and I just went on a trip down to Fort Lauderdale for an advisor training. And if you ever watch the flight pattern, a plane, most of the time it's off course by a degree or two. And so it's never just a straight line. It's on track, off track, ahead of schedule. And it's just like retirement. You've got to make those minor adjustments to keep you between those guardrails.
Do you build in, just as a quick follow-up to that, Scott, do you build in that room for error just on the plan as a whole, on one particular section, or lots of different things? Are you very specific and, hey, let's have room for error in what you're going to need in terms of how much your money you're spending each month? Let's also build in room for error in inflation. And do you kind of apply it to every calculation that goes into the pie?
Yeah, some of the big ones that we look at is, like we talked about, we operate with, hey, what's the minimum rate of return that we need to get this to work? That's number one. We can use a higher than average inflation. We can use a longer than expected life expectancy. And so we stress test all those things to say, hey, here's something that's going to throw you off track. And then it's about a course correction and to make sure we come back on the path. And again, most people, they're not going to set the cruise control for retirement and just gradually speed up and not course correct. And so most people, there's plenty of room before you go off the rails to make course corrections. And again, that's why we never print this 300-page financial plan. It's about financial planning to make sure you stay on track and you're comfortable with the results.
Planning is something that continually happens, not just after the first plan is built, but it's going to continue through the relationship with an advisor, right?
Oh, most definitely. And really, and kind of as we close it up today's episode, I encourage everyone to go get this book or listen to his podcast, because he talks about a lot of stories on his podcast. So you can just listen to it. But the book reminds us that successful investing isn't just about what you know. It's about how you behave. So if you want to explore more insights like these, subscribe to our channel and join us for the next installment of our financial book club, which is coming up here in the near future. And if you've read The Psychology of Money, drop your biggest takeaway in the comments below. We'd love to hear it from you.
Yeah, that would be cool to read and see what has jumped out to people. So thanks for interacting with us here on the show. If you choose to do that, you can always throw us a thumbs up and a like if you enjoyed today's video. Share it with others who might find the information helpful as well. If you're interested in talking to Scott more specifically about your financial plan, your retirement future, you can certainly do that and talk with the team at Elevated Retirement Group. We've got a link in the description of today's show where you can schedule a time to visit, plus other resources available to you as well. So check those out. That's all in the description of today's show and always online at listentoscott.com. Scott, thanks for the help today. We'll talk to you next time.
Looking forward to it.
All right, we'll see everybody soon right back here on Your Retirement Elevated.
This video has been prepared for educational and marketing purposes only. The information in this video is general in nature, does not constitute personalized investment advice, and does not provide a complete analysis of the subjects discussed. All investments involve risk, and different types of investments involve varying degrees of risk. There can be no assurance that any specific investment strategy will be profitable or suitable to you. Additionally, although information presented in this video is believed to be factual and up to date, we do not guarantee its accuracy. You should consult an attorney or tax professional regarding your specific legal or tax situation and should consult a professional advisor before implementing any of the strategies mentioned in this video. Investment advisory services are offered through Elevated Capital Advisors LLC, an SEC-registered investment advisor affiliated with Elevated Retirement Group LLC. Registration as an investment advisor does not constitute an endorsement of Elevated Capital Advisors LLC by securities regulators, nor does it indicate that the firm has attained a particular level of skill or ability. Insurance advice and products may be offered by a third-party insurance producer, which may be affiliated with Elevated Retirement Group LLC and Elevated Capital Advisors LLC. Walter Storholt and Third Wheel Media LLC receive compensation for their assistance in preparing and hosting this video.